I'll continue. After giving you the elimination entries on December 31, 2017. From a consolidated point of view, Pitt Corporation's December 31, 2016 retained earnings was overstated by 800, representing unrealized intercompany profit in say companies' inventories on December 31, 2016. This unrealized profit was charged to cost of goods sold when say company sold the inventory during the period, thus overstating the cost of goods sold for 2017. By the way, for the elimination entries on December 31, 2016, for the elimination entries on December 31, 2016, which we did not have. The elimination entries on December 31, 2016, number one is to debit sales by 10,000 and to credit cost of goods sold. So the number one, debit sales, credit cost of goods sold by 10,000. By 10,000. The second entry is to debit cost of goods sold by 800 and to credit inventory by 800. So debit to cost of goods sold by 800 and to credit inventory by 800. These elimination entries remove the overstatement. These elimination entries remove the overstatement of the consolidated amounts, removes the overstatement of the consolidated amounts for sales and cost of goods sold. The consolidated amounts for sales and cost of goods sold. The last elimination entry, debiting cost of goods sold and crediting inventory. The last elimination entry, debiting cost of goods sold and crediting inventory, removes the intercompany profit, removes the intercompany profit from six cost of goods sold, removes intercompany profit from six cost of goods sold, thereby reducing the consolidated inventories, thereby reducing the consolidated inventories to actual cost, reducing the consolidated inventories to actual cost for the consolidated entity. For the consolidated entity. Now, that is in case of December 31, 2016, involving sales and cost of goods sold. Okay? So, we now go to the consolidated comprehensive income. We go to the consolidated comprehensive income computed and allocated on December 31, 2017. We go to the consolidated comprehensive income computed and allocated on December 31, 2017. Okay? So we are now given the assumed consolidated income of both companies. We are now given the assumed consolidated income of both companies. So we now begin with Pitt Corporation's consolidated income from own or comprehensive income, Pitt Corporation's comprehensive income from own operations. Pitt Corporation's comprehensive income from own operations, excluding dividend income. Excluding dividend income, 80,000. Now, stated earlier, most of these figures are assumed. So, excluding dividend income, amount of comprehensive income is 80,000. Okay? Add realized profit in the beginning inventory. Add realized profit in the beginning inventory. Add realized profit in the beginning inventory for the downstream sale. Add realized profit in the beginning inventory for the downstream sale. Downstream because it's from parent to subsidiary. So the amount is 800. We have to add. Add 800. Then, next, unrealized profit in ending inventory. Unrealized profit in ending inventory for 1,200. Deduct from ending inventory. Deduct. Take note that 800 pertains to the beginning inventory and 1,200 to the ending inventory in the year 2017. So the difference is 79,600. Difference is 79,600. This is Pitt Corporation's realized comprehensive income from outsiders. 79,600 is Pitt Corporation's realized comprehensive income from outsiders. 79,600. Then we add, say, companies' comprehensive income from own operations. Say companies' comprehensive income from own operations. 50,000. Again, assumed 50,000. So the total is consolidated comprehensive income. By the way, comprehensive income, you just abbreviate CI. Consolidated comprehensive income. Comprehensive income or CI. Okay, so we have 129,600. 129,600. And then we deduct attributable to non-controlling interest. Attributable to non-controlling interest. 50,000 times 20%. 50,000 times 20%. So attributable to non-controlling interest, 50,000 times 20%. So you get 10,000. 10,000. The difference is attributable to parent. Attributable to parent, 119,600. Attributable to parent, 119,600. So that's the amount of net income now attributable to the parent shareholders. Okay, now we go to the upstream sale of inventory. Okay, so in upstream is the reverse of downstream. In upstream sale of inventory, those sales from subsidiaries to the parent. When an upstream sale of inventory occurs and the inventory is resold by the parent to outsiders during the same period, all the parent entries and the eliminating entries in the consolidated working paper are identical to those in the downstream case. When the inventory is not resold to outsiders before the end of the period, working paper eliminating entries are different from the downstream case only by the apportionment of the unrealized intercompany to both the controlling and non-controlling interest. Okay? Therefore, the elimination of the unrealized intercompany profit will reduce the interest of both ownership groups until the profit is realized by resale of the inventory to outsiders. Now, we have the summary of comparison of working paper elimination entries regarding the downstream and the upstream sale. Regarding the downstream and the upstream sale. Okay, so we now have the comparison of your downstream and the upstream sale. In the case of your, this time, we are dealing with the downstream sale. Okay, so with regards to any questions? Any questions? We are now in the upstream sale of inventory. Upstream sale of inventory. Okay? So we now go to the comparison. In the downstream sale, we debit to sales credit cost of goods sold. In the upstream sale, we again debit to sales credit cost of goods sold. Debit cost of goods sold by 800 and credit to inventory for the year 2016. In the case of 2017, we now debit to sales and to credit cost of goods sold, the same entry here. And debit to cost of goods sold 1,200 and credit to inventory. How about with regards to retained earnings? In the books of Pitt Corporation, we now debit 800 and to credit cost of goods sold by 800. Here, in the upstream sale, we debit to retained earnings for 640, and that's the 80% portion. And we now recognize the non-controlling interest in the amount of 160. Now, these are involved in our upstream sale. Now, let's have this computations for the non-controlling interest, no? For the elimination entries, take note that we have similar elimination entries and even with the other entries in the books of here, the consolidated entities. For our computations of non-controlling interest, here, what's important is in the last year, we have the non-controlling interest given a share equal to 160 pesos. Okay? I think we will involve more of these problems in our book of Dayag. So we will just take time in the book of Dayag to consider these terms, upstream and downstream. Now, I have included in my test chapter 4 of Dayag, which I told you I will get some items in the book of Dayag. That's why I really would like to begin with the Dayag, so you will be familiarized with the problems stated. So shall we now begin with the problems in at the end of the chapter? We now have the problems in the multiple choice, and we also have the theory. For the theory part, in the book of Dayag, we have true or false, we have multiple choice theory, and we also have the multiple choice problems. So let me give you first the true or false. Let me give you first the true or false. Let me give you first the true or false in chapter 4 before we move on to the problems. Okay? So will you open your books now in chapter 4 with the multiple choice and the true or false? I'll just give you the answers to the true or false. 1 to 40. Okay. 1 to 22. So number 1 through number 2 and 3 false. Number 4 true. Number 5 false. Number 6 true. 7 false. 8 false. 9 true. 10 false. 11 true. 12 false. 13 false. 14 true. 15 true. 16 false. 17 false. 18 true. 19 true. 20 false. 21 true. 22 false. Okay? For the true false, meaning we have only 1 to 22. And then the rest are already in multiple choice. So for the multiple choice, we begin with number 23 up to 80. So number 23, boy. Okay. 23, boy. 24E. 25A. 26E. 27E. 28C. 29, dog. 30A. 31, boy. 32E. 33, boy. 34, dog. 35A. 36A. 37, boy. 38E. 39, dog. 40, dog. 41, boy. 42C. 43A. 44C. 45, dog. 46C. 47, boy. 48C. 49A. 50, dog. 51A. 52C. 53C. 54, dog. 55C. 56C. 57, boy. 58C. 59, boy. 60C. 61, 62A. 63, boy. 64C. 65A. 66 boy, 67 boy, 68C, 69 dog, 70 boy, 71 boy, 72, 73, 74A, 75C, 76C, 77C, 78A, 79C, 80E. Okay? So we already have your theory, including the multiple choice, and you have your straight problems later to follow, and your multiple choice problems. Okay? So can we begin with the multiple choice problems? We have the multiple choice problems. I'm going to start with problem number 1. The multiple choice problems, we have here, use the following information with the multiple choice problem, or you would like to begin with some straight problems. We have straight problems here. You will notice that the very long problems in problem 1. Problem 1 is still related to the problems that we have in the previous chapters. Problem 1. While there are problems like problem 3 is quite shorter. Problem 3, problem 4, it's shorter as compared to problem 1. And anyway, we can take up probably problem 3 first, no? Before we move on to the multiple choice. Whatever we can finish up to probably after the Zoom will end by 11, I can have another renewal. So we will end up to mga 11:40. Is that okay with you? Is that okay with you? That we will end up to 11:40? So we can take up some problems. Otherwise, if you don't want, then we can just end up 11, but you take charge of the problems. So how about that? Are you going to, is it okay after 11, we move on up to 11:40 and take up more problems? Or we end up only 11? And for you to take charge of problems that I'm going to give you. Huh? Any comment? Hello, class? Any comment? Hello?
Okay lang, ma'am.
Okay lang? I'll move on to 11:40. Hello?
Yes, ma'am.
Yes,
Yes,
ma'am.
Yes,
ma'am.
ma'am.
Okay. Now, will you refer to problem 3 on page 428? Problem 3 on page 428. Downstream sale, working paper elimination entries, and consolidated net income. Puma Company owns 80% of the common stock of Smarte Company. Puma sells merchandise to Smarte at 20% above cost. During X4 and X5, intercompany sales amounted to 1,080,000 and 1.2 million respectively. At the end of 20X4, Smarte had 1/5 of the goods purchased that year from Puma in its ending inventory. Smarte's 20X5 ending inventory contained 1/4 of that year's purchases from Puma. There were no intercompany sales prior to 20X4. Puma reported net income from its own operations of 720,000 in X4 and 760,000 in X5. Smarty reported net income of 400,000 in X4 and 460,000 in X5. Neither company declared dividends in either year. Requirement number 1, calculate controlling interest in consolidated net income. B, non-controlling interest in consolidated net income and consolidated net income for 20X5. 2, prepare journal entries in the books of Puma, the results of operations of Smarte, net income, dividends, if any, amortization of allocated excess, and intercompany profit under the cost and equity model. 3, prepare in general journal form of entries necessary on the consolidated statement, work papers, to eliminate the effects of intercompany sales for 20X4 and X5. Now, let's begin with requirement number 1, controlling interest in consolidated net income. So we have now, take note, we are using Puma and Smarte. So for Puma, we just use P, and for Smarte, we use S. Okay? First, in requirement number 1, computing for the consolidated net income for 20X5. P company's net income from own operations. P company's net income from own operations, 760,000. 760,000. Then, realized profit in beginning inventory, realized profit in beginning inventory of S company, downstream sales. Now, we will have this in the next computations. Realized profit in beginning inventory of S company for the downstream sales, 36,000. 36,000. Remember, that's on beginning inventory. Then we have unrealized profit in ending inventory of S company for 50,000. Deduct. Okay? So beginning inventory, add 36,000 and deduct 50,000 on the ending inventory. So the net amount of 746,000. 746,000. That is P companies realized net income. P companies realized net income from separate operations. P companies realized net income from separate operations. Okay? From separate operations. So we can say that realized from separate transactions with the third parties. Okay. Then we have to indent S company's net income from own operations. S company's net income from own operations, 460,000. 460,000. So we are now going to add 460,000 to 746,000. Class, remember that this time there is no upstream sales, but we only have downstream sales. So we add 746,000 and 460,000. We get the total of 1,206,000. Of 1,206,000. Of 1,206,000. Okay? So what do we get there? 1,206,000. And from this, we deduct the non-controlling interest in net income. We deduct the non-controlling interest in net income, which we are going to compute later. The non-controlling interest in net income is the amount of 92,000. The non-controlling interest in net income is the amount of 92,000. So the difference is the controlling interest in consolidated net income or the profit attributable to the parent or the profit attributable to the parent in the amount of 1,114,000. The profit attributable to, or we have the controlling interest attributable to the parent, the non-controlling interest attributable to the parent, that's in the amount of 1,114,000. 1,114,000. That's in requirement letter A for the computations of the consolidated net income. The consolidated net income. Okay? So we started with 760,000. The consolidated net income for 20x5. That's the requirement in number 1. Compute for the consolidated net income for 20x5. That gives us requirement number 1 for A, B, and C. Finally arriving at the consolidated net income, wherein 1,114,000 is for the parent. So the consolidated net income is 1,206,000. Okay? And the share of the non-controlling interest is 92,000, whereas the share of the parent is 1,114,000. Now, let's show how the non-controlling interest was arrived at in the amount of 92,000. Okay? So, as company's net income is 460,000. As company's net income is 460,000. Then there are no upstream sales. So the realized net income of S company from its own separate operations is 460,000. We multiply it by the 20% non-controlling interest. We multiply it by the 20% non-controlling interest. So we now get the non-controlling interest in net income of 92,000. So that supports the non-controlling interest we included in the computations. By the way, we are asked in requirement number 1 to determine the consolidated net income only for 20x5. And likewise, computed was the controlling interest and the non-controlling interest. So the final answers are number 1, letter A, controlling interest, 1,114,000, non-controlling interest, 92,000, and consolidated net income of 1,206,000. Next, we go to requirement